Okay, we have one last question basically to address this semester, and we're still working with Ann and Andy, right? So I had a discussion with Tyler about Ann and Andy, and they are fictional people, but there's some of my real life experiences embedded in some of these things that I've put in here too. So Ann and Andy, they decided to buy this house, remember? Do you remember the house from last time? How much? Do you remember how much it was without looking? It was $120,000. That's how much they were going to pay for it, and they were going to put $20,000 down because the institution would loan them $100,000. Right. Okay, remember that? So those were our numbers from last time. One of the things that some financial advisors will recommend is not paying off your home early because you lose a tax write-off. And in fact, we talked about last time that you do get a tax write-off. It writes off two things on your taxes when you own a home. It writes off, number one, your property taxes. Okay, so, and it occurred to me last time after I left that you may not realize that property taxes happen whether you have a mortgage or not. So when you have a home, when you purchase this home, you will pay the property taxes forever while you're in that home. The property taxes pay for things like, we got ours in the mail recently, they pay for the school district, so they pay for the public school education wherever you live. They pay for maintenance of roads. They pay for that local area. Okay, so that's what property taxes pay for, and they recur every time. So they're not affected by this paying off business. They get to be included in your write-off on your taxes regardless. Okay, but the part that is affected on whether or not you still own, still have a loan, is the interest. So we mentioned last time, and it was a typo when I actually realized it, but the mortgage interest is tax deductible as well. So the amount you pay in interest can be taken off of what you consider your income of your taxes. So if you make $40,000 a year and you paid $5,000 in interest on your mortgage interest, the mortgage interest, then what the federal government does, or what your tax accountant does, is they take your $40,000 and they subtract off the $5,000 you paid in interest, plus any charitable giving. That's another thing that you can do, right? You give to your church, you can write that off. And they take that off of how much you have taxable income for. Okay, so everybody follow me? So you'd only pay taxes on $35,000 now instead of $40,000 because part of it was your mortgage interest. So some tax advisors, some financial advisors would tell you, don't pay off your home early because that mortgage interest is saving you money on your taxes. Sounds fairly reasonable, and it's a pretty common misconception, and I'm going to show you why. All right, so you'll have to pay more money in your taxes, but let's consider if this is good advice within the context of Ann and Andy's situation above. All right, so Ann and Andy's loan was a $100,000 loan. It was 3.75% interest. Everybody remember that? We're all good. Okay. To start with, and this is an estimate, that's why the word approximately is here. I don't know if the word approximately showed up when I actually made your notes or not, but it is an approximate. So we learned how to do amateurism.
Which page would this be on?
Whatever's the next page of your notes.
It's example 2.
We're on example 2, part A. Mm-hmm. All right, so we learned about amortization last time. Remember that table we filled in? And one of the things that showed up in that table is that every month you pay your payment, the monthly interest is slightly less the next month. Remember that? Okay, so, but they were awfully close. I think Mark may have been the one that said, man, it's like $1 difference. Right? It wasn't much difference from month to month. All right, so we're going to, for the moment, place pause on the fact that there is a slight monthly difference, which is why the word approximately is here. Okay? All right, so here's the deal. The question is, how much would Ann and Andy pay approximately in interest the first year of their loan? We've encountered this formula so many times. What is my interest formula?
I equals PRT.
I equals PRT. What is P in this problem? $100,000. Their interest rate is 3.75, so it's 0.0375. And then we're talking about 1 year, right? Last time when we did it, we talked about months, and so we did 1 over 12, right? So this isn't exact, right?
It's always year.
Yes, the T is always in years.
T is always in years.
T is always in years.
So 3,750.
Okay, so what did you get?
3,750.
All right, so $3,750. Is that what you have too, Hillary? Mm-hmm. Awesome. Okay, so they are going to pay $3,750, give or take a little bit. Okay, everybody with me on that? This is not precise, because if we wanted it precise, we'd have to do an amortization table for 12 months. Okay, but it's not going to affect what I'm trying to show you after this anyway. So this is an approximate amount of interest in a year. right, so thus the amount of income that Ann and Andy will pay in taxes will be decreased by the amount above. So whatever they make in income, wherever they work, whatever they do, you take their income amount and you take off $3,750, and that's their new amount that they're going to pay taxes on. And there's other things that get taken off of this number as well, but we're just talking about the home ownership part right now, okay? Everybody with me? So they're going to pay, it's not that they're going to pay $3,750 less in interest. That's how much less income that the government is going to recognize them as having.
So if they make $40,000, they're going to take 37.
Right. So they're going to have $36,000 something that they're going to pay their interest or their income taxes on instead. Okay? But here's how this would happen. Okay, so whoever you are, you're at a certain tax bracket. So I made up a 25% tax bracket, but you're at some tax bracket. Okay? So Ann and Andy, tax bracket is how much of your income is used to pay for our federal government. So if you are in the 25% tax bracket and you make $40,000 a year, how much of your income goes to Washington? 25% of it, which would be how much? $10,000. Did you know that? Okay. And, this whole discussion that, keeps coming up, this whole fair share and people who make a lot of money and whatever, you have to understand that the way our system works, the more you make, the more percentage you pay. Not just the more money, but the more percentage. So the people who make a lot more, their tax brackets are higher too. So they may be in a 40% tax bracket. Okay, so they make more money, I get that right, but they also pay a higher percentage of their money in the tax bracket they're in. This is the way your system really works. There's no fog and mirrors. There's no lights and whatever. That's not what's happening. There's a tax bracket, and you have one. And yours may not be 25%. It may be something else. But everybody has a tax bracket that they're in, and it's based on your income amount. Okay, so there's lines that are drawn, and it's always a mystery to me how you decide where the lines are and whatever. But you have a certain percentage tax bracket. Okay, so we're going to use 25% for argument's sake for this one for Ann and Andy. Okay. Now, it says, Ann and Andy are in the 25% tax bracket. How much will this decrease in their income? It's not really a decrease in income, but it's reportable income, okay? Save them in taxes. Well, we decreased their income by how much?
75.
New, last problem. $3,750. We decreased their income by $3,750 due to the mortgage part. So they no longer are going to pay interest not interest, but pay taxes to the government on the $3,750. And if their tax bracket was 25%, they would have paid 25% of this money to the government, right? Not all of it. They would have paid 25% of it to the government. So somebody grab a calculator for me and tell me what is 25% of $3,750.
Wait, why are we finding the percentage of the 37?
Because it's how much money they're actually going to save that they don't have to pay taxes on. They don't have to pay taxes on the $3,750. If they were to pay taxes on that $3,750, this is how much taxes they would have paid.
Why isn't it 0.025?
Because 25% is the number 0.25.
A quarter out of a dollar.
It's 937.
Like 25 cents out of a dollar. Yeah.
It's 937.50.
9.
What's it?
So $937.50. Okay, so here's what happened. All right? And it's filled in the blanks right here, kind of like in church on Sunday morning when you fill in the blanks. Do any of your pastors do that? Ours doesn't right now, but I've had pastors who have. Ann and Andy got their loan from a credit union. That's how I set the problem up before. They got the loan from the credit union, okay? And their interest on the loan was how much? Okay, let me say it. The interest amount, not the percentage. How much money did they have to pay in interest in 1 year? $37.50. So instead of, I'm sorry, hang on. They're paying the credit union $37.50. That's their mortgage interest in that first year. So they're paying $37.50. I mean, and if they don't have an option to pay it off, that's fine. I mean, they're going to have to pay the mortgage interest, and sure, we're going to take the tax break and whatever. Okay, fine. But if they could pay it off, and they chose not to, that would mean they were choosing to pay $37.50 in interest. Are you tracking with me? And if they did it for this reason, they saved, well, no matter how they did it, they saved themselves some money, and they didn't have to send to the government. How much did they not have to send to the government?
$937.50.
Thus, Ann and Andy are paying the credit union $37.50. That is $3,750 in order to keep from sending $900 to the government. Now, I know we used an approximate, but the percentage was an exact thing. I made it up, but there is a percentage rate. And if you percentage this out, what you would find out is that 75%, namely the part that wasn't 25%, was extra money that they were sending to the credit union so that they didn't have to send it to the government, right? So if they're able to pay off their mortgage quicker, does it make financial sense to delay paying off the home for tax purposes? No, it cost them money, didn't it? So if they had an opportunity to pay it off early, would this be a benefit to them? Yes. Would they pay more in taxes?
Yes.
Yes, but would they pay less in interest?
Yes.
Yes. Okay? So in the grand scheme of things, the issue is still that in the end, you're going to save more money by not having the mortgage interest than you're going to fail to have to give the government by paying the tax rate. All right? I want to show you a few other things in this section because you need to be aware that they're out there from very much just a sense of this is real life stuff you're going to encounter at some point. Escrow is one of those things. Escrow is actually a reserved account. It's maintained by the mortgage lender, so whoever you borrowed your money from maintains this account. It's kind of like a savings account in their bank. Okay, it's an account. And the taxes and insurance, what it does is it collects your taxes and insurance from you up front, and then they're the ones who are responsible for paying the taxes and insurance. Escrow is a good thing if you're concerned that maybe at the end of the year you're not going to be able to pay those taxes because you aren't diligent at setting aside money for the taxes or for the insurance, because it's sort of an automatic savings program, right? It's kind of like there's some employers who will require that you put a certain percentage of your income into a retirement account. It's not optional. I worked at a school once in Ohio. At the school I worked at in Ohio, it was required that I put 4% of my income into my retirement account. I had no choices. Okay, an escrow account is kind of like that. Mm-hmm.
Do you earn interest on that money?
No.
That way?
Which is exactly why, from a financial perspective, it's not very wise. So I will tell you, we're on our 4th house that we've owned. And contrary to an email that I got from a student at the school, I'm not a middle-aged teacher. Let me just clarify that. Probably not a good thing to say to a professor that they're middle-aged, just so you know. I'm 33 years old, all right? And we've owned 4 houses. Isn't that crazy? I think it's kind of crazy. We obviously made some bad decisions along the way. We did. The first 3 houses that we owned, we did an escrow account. And we did it because I thought, well, yeah, I don't want to have to remember at the end of the year to pay this stuff. I don't want to have to be the one setting aside every month, money for my paycheck. I didn't want to deal with it. And so there's that aspect of it. In fact, I had a sister-in-law who chose to do no escrow account, and I thought, well, that's dumb. Why would you do that? And not until we purchased the house that we are in now did I understand how escrow accounts work. Had no clue. And Mark already caught on why. Because what I just told you in here that an escrow account does is it takes the money from you up front, and they keep your money up front, and they don't give you any interest on it. They make more interest on your money that they're taking up front to pay some bill off later in the future. Okay? So you might as well just put it in a savings account, which is what we do now. Okay, so again, that requires that you actually put it in a savings account. So every month I have a certain amount of money pulled out of my checking account. I mean, I do it physically. I move it between spreadsheets. I'm kind of a spreadsheet nerd. And I move it between lines of my spreadsheet, and it moves into my property taxes fund. And that's just what I do. I move it over there. And I actually have our property taxes, not property taxes, but my insurance set up to do an auto withdrawal monthly through the insurance company, which you do with car insurance too. And so our car insurance and our house insurance just get pulled automatically from by the month, from our checking account. I don't need somebody to hold my hand and do that anymore, because I feel comfortable enough to go ahead and do that and be diligent and set aside that money every month for my account. But that's what an escrow account does. Is it protects you if you're not sure you're going to be able to handle that prospect. Because remember we talked about property taxes last time? They can amount to several $1,000s a year, and if you get to the end of the year and you don't have that several $1,000s, we got a problem, right? Right. So an adjustable rate mortgage. So we've talked about only one type of mortgage so far, and that was, do you remember what it's called? Fixed rate. Adam's right. So the fixed rate mortgage. And I mentioned when we talked about a fixed rate mortgage that the part that was fixed was the rate, right? The rate never changed. So if you got in like Ann and Andy at 3.75% and you never did something called refinance, which is where you go back to the bank and you ask for a better rate, then it's just going to stay at 3.75%. So in other words, the big thing is that the bank can't arbitrarily or with justification decide that they want to increase it to 5%. Okay, it's fixed. It's set. An adjustable rate or a variable rate mortgage do not have that feature. So they do not have a fixed rate over time. Generally, they'll start at a lower rate. So maybe Ann and Andy would have been tempted to go with a 3% ARM, ARM, right? ARM, adjustable rate mortgage, because it was 3% instead of 3.75%. Okay? But the kicker is that generally over time, what do you think is going to happen? They're going to go up. Okay? So we're going to take a look at how, and they go up periodically, and we're going to take a look at the things that happen with ARMs, okay, with adjustable rate mortgages. First of all, there's an adjustment period. It's the time between rate adjustments, typically 1, 3, or 5 years. So every 1 year or every 3 years or every 5 years, your rate may change. And that's set out in the original documents that you sign and agree to, okay, how frequently. We'll keep going. Pause on that question for a second. The index is the standard fluctuating average that is the basis for a new adjusted rate, which is what you asked me about. So in the paperwork that you signed, they will tell you what the index is, the average by which they expect that it might go up. Okay, that's the index. The margin, though, is any additional amount that could be added to the index by the lender. Okay, so we may also have a margin, another interest increase. And the discount is the amount by which the initial rate may be less than the sum of the index and the sum of the index and the margin. So they may decide every 3 years, if yours is a 3-year adjustment period, that they're going to repull your credit report. Your credit goes up, you may get a discount, right? You've got an increased credit score, you've made all your payments on time, you're doing good. They may pull your credit report and something happened that was unfortunate during that time frame. Maybe you were unemployed for several months and so you had some late payments, whatever, and your credit rating went down. If that happens, what do you think is going to happen to your interest rate? It's going to go up, right? So a credit report may be a reason why they decide to increase or decrease your adjustable rate mortgage, okay? The other thing that might change is what current housing trends are, right? So right now, I can't even remember what our mortgage rate is, but it's 3 point something, okay? So a year from now, maybe we have a huge increase in mortgage premium or mortgage interest rates. Maybe a year from now, we see that we have mortgage rates that are closer to 5%, which would be a big jump. Still not a bad interest rate, but a big jump. Well, with my fixed rate mortgage, I'm stuck. I get my 3 point whatever it is. We'll say 3.75 because that's what Ann and Andy's was. I get to keep my 3.75%. But if I were having an adjustable rate mortgage, the lender would say, well, we can charge you more because if you decided you didn't want this mortgage anymore and you were to go and refinance it and get a different mortgage, you'd have to pay more mortgage interest anyway, right? So because of current housing trends, whatever's happening in the housing market, you could see an increase in your adjustable rate mortgage at the adjustment periods. There is a cap that is a limit on the interest rate increase. And that's an interest rate cap, so that's the cap on the interest rate. There's also a cap on the periodic rate, the limit on the rate increase per adjustment periods. So typically about 1% per 6 months or 2% per year. Okay?
You can only change that much in a year?
Yes. And again, that's set out in, so this is what it says typically. That means that the paperwork that the lending institution gives you may say something different, but this is sort of the norm. Okay? And so this would be the most it could change in a given 6 months or the most it could change in a given year. The overall cap is the limit on rate increases over the life of the loan, typically about 5%. So again, if Ann and Andy got in at a 3% loan, they would know that worst case scenario, their loan would go up to 8%. Right? That's what this is saying, right? There's a cap on how total how much their loan can go up to over a given time. Okay, so it's an overall cap. And then there's a payment cap as well, a limit on how much the payment can increase each adjustment period. So maybe the payment cap is $100. I don't know. So that may be sort of what Ann and Andy's thinking is how does it affect my personal budget this month kind of thing? And this would be their question to ask, right? What's my payment increase possibilities? All right, so here is an interesting situation, and so maybe you do know and maybe you don't, but there's been some sort of thing called a housing market crash a few years ago. You're familiar with hearing some things? Maybe you were unfortunately caught up with that with your parents, and maybe it affected you. I don't know. But A lot of loans were being given out in a lot of situations that weren't perhaps the best situations. Maybe it was people who didn't really have the credit that they should have, so they hadn't really shown that they could pay payments on time. Maybe it was because they were being loaned too much money for their income. We talked about the house poor situation last time, right? So then when one parent, if it's a dual income family, one parent lost a job, that's 50% of your income. You obviously can't make your house payment if your house payment is 50% of your income and 50% of your income goes away. These kinds of things. The other thing that was happening is that people were getting adjustable rate mortgages and interest rates were flaring up, right? This isn't good. And then fourth, I don't know what I'm on at this point, but another thing that was happening too is there were a lot of mortgages that were going in where the only thing you paid for the first, say, 5 years was interest. They were interest-only loans. I have a friend in Ohio who's trapped in an interest-only loan. And she can't refinance because the price of her house is less than when they bought it. So they owe more money on their house than what it's worth. And they can't refinance because they don't have the cash to pay a down payment. So they're stuck in an interest-only loan. All right? Interest-only loan means you're only paying the interest. We did the amortization schedule last time, right? So you're only paying the $200 and $300 for your Pinterest payment, but it means that you still owe $100,000 every time, right? Well, a negative amortization is what happens when your loan principal actually increases over time instead of decreasing over time, and that can happen with an adjustable rate mortgage. Mark?
That, you said your friend has the what loan?
It's called an interest-only loan. I don't even know that they are allowed to do them anymore. There's a big fiasco with that stuff.
Like in a situation like that, if you paid more than the interest, wouldn't that go against your principal?
Yes, it would. That is true. But she still can't refinance, which is where I'm saying she's stuck. It's not that she's stuck in only making interest payments. It's she's stuck in the ability to actually go get a better rate. She can't go and get a better rate on her mortgage because nobody will give her the money because she owes more money on the house than what it's worth. So I don't know exact numbers, but let's say it's something like they owe $250,000 on a $200,000 house.
So
Well, nobody wants to insure $50,000 of something that's not.
But if they paid that $50,000 and got down to where it was, then could they refinance?
Yes, they could. That's exactly what they could do.
Okay.
Yes. And what will happen is at the end of their, I think it's a 5-year interest-only balloon is what I think it's called. At the end of that 5 years, what will happen is it will turn into another kind of loan where they start making payments on both the interest and the principal, but their rate, it's going to go up. And so if they don't make any change between now and then and do something like what you suggested and pay off that extra, say, $50,000 that the house is no longer worth currently, then they're not going to be able to get a better rate. They're going to be stuck at whatever that rate was. And the reason they did it, and I know the reason they did it, is because they didn't think that they were going to be staying in this house very long. Her husband's job was in such a situation, she thought 2-3 years they were going to be moving anyway. So, and the housing markets just kept going up. Prices of houses kept going up. So their thought was, we'll just turn around in 3 years. We'll sell it for more than we bought it for. We'll have made just interest-only payments. It won't matter. Life doesn't always turn out like you think it's going to. Sometimes it ends up being that you're somewhere longer than you were intending to or shorter than you were intending to. This is actually, let me mention one more thing here since I mentioned the longer intending situation with my friend. When we were in Ohio, we went ahead and purchased a house for various reasons, not the least of which was that we were adopting, and we needed our stationary address to stay permanent so we didn't have to incur more costs with our adoption, so we really wanted a house. The other issue was we have 2 cats and a dog, and if you ever try to get into a lease on a piece of property with 2 cats and a dog, let me know about it because it's very difficult to find. People don't want their house being destroyed by animals, and my animals don't destroy anybody's house, but I can tell you that, and it's your house, so you don't have to believe me, right? And so it's very difficult. So we didn't want to get rid of the cats or the dog.
The cats?
But the issue was if we got a house, if we purchased a house, then we could have all of it. We could have the whole package deal. And when we went, we thought, well, it's fine. We're going to stay here forever. 3 years later, we're not there anymore. And we have a house that we can't sell because the housing market crashed. And at the point when our house finally did sell, we came out fairly even, but the house sat empty for 10 months. Our mortgage payment was $1,500 a month for 10 months. How much money did we lose? 15 grand, and we were so happy that it wasn't more, to be very honest. One of the defaults that people will tell you is that you should make sure that you are in a location or planning to be in a location. Of course, our plan was, but planning to be in a location for a minimum of 5 years if you're going to buy a house. So if you know you're going to be there only 3 years, say military, right? The military usually are there for 3 or 4 years. It's probably not in your best interest to buy a house because you may have a market crash or something happen that you don't end up being able to sell that house very quickly. Convertible features, actually I mentioned this one with my friend's situation. This is a contractual ability to convert to a fixed rate mortgage, usually at a designated point in time. So her situation right now is, and I don't know what her numbers are exactly, and I wouldn't ask because I think that would be asking too much, but let's make up a little bit. So let's say she has a 3% interest-only loan, so she's only paying 3% a month on that $200,000 loan she got, right? Well, at 5-year mark, she has the ability to change that loan into a fixed rate mortgage loan, or maybe an adjustable rate. This one's talking about a fixed rate, so let's say it's a fixed rate loan. But the kicker is that to change it into a fixed rate loan, they're not going to give it to her at 3% anymore, right? Maybe they're going to give it to her at 7%, and she's going to be really bummed because that's twice the going interest rate potentially.
The next year it should raise to 5.
So what?
The next year it should raise to 5%. The fixed rate loan is going to stay at 3.75.
Yeah, and the fixed rate loan will stay at the 3.75, exactly. So there's sort of some safety in the fixed rate loan. It's the conservative, right, the safe way to go. Prepayment penalty, the last one, and there are some loans that do this, and they are variable rate mortgages that charge you a penalty if you pay the thing off early. So it's like Merry Christmas, here's a bill, right? So you pay the thing off early. So if my friend decided she was going to pay that mortgage off early, they would charge her a penalty for having done so. And again, that has to be disclosed in the original paperwork that they signed, but it is another issue about variable rate mortgages. I think that's my last one. The thing I want you to take away from the situation is this. I'm not assigning you any problems on variable rate mortgages. Nobody said thank you.
Thanks.
Oh, okay, thank you. All right, so I'm not assigning you any problems. What I want you to see is how complicated they are and how potentially scary maybe they are. There's a lot of unknowns. There's a lot of things that can change and that can change very quickly, really, to your disadvantage, right? So who's going to get an adjustable rate mortgage? Oh, Tyler thought he was, but he's not going to now. They're scary, right? They just pose a very, very big risk. Yes?
I'm just curious,
Mm-hmm.
like, I understand, like, the negative implications of it.
Yeah.
I'm just curious, like, what are some of the positive implications?
Okay, so my friend, right, if they really had moved in 2 years before the market crashed, they would have come out well because they would have paid less interest overall. So you'll see some people who, the times where you see a variable rate mortgage sort of maybe encouraged by someone who normally wouldn't encourage it, would be in a situation where someone is only planning to be there for a couple of years anyway. And so presuming that the market doesn't crash and you're actually able to sell the home when you're done, an adjustable rate mortgage might make financial sense. But again, we just assumed a lot, didn't we? And that's the problem, is that you probably shouldn't have been in the home to begin with if you were only going to be there for 2 years. And so a lot of people were getting, and back in, before sort of the scary mortgage stuff that's been going on now, getting adjustable rate mortgages because they didn't intend to be there for very long. Maybe they thought they were moving, maybe they thought they were going to upgrade in-house, maybe they thought whatever. And so they didn't intend to be in that house for very long, so an adjustable rate mortgage sounded really good. I've got 5 years. All I'm going to have to pay is interest for 5 years, and I'm going to be out of here before then anyway. I'll turn around and sell the house, no big deal. And that's great until you can't sell the house for a year or longer. So does that make sense? Mm-hmm. So, I mean, that's kind of the selling point. The selling point is the less interest rate, and that you've got a certain time by which you can actually, save money. And you can. I'm not arguing it. You definitely can. It's a lesser interest rate. Absolutely. Sounds like a good deal. But there's a lot of scary features that are coming at you very quickly that you can't control, and that's the problem. All right.